Welcome to Objective 7 in Unit 4 of Accounting 3310. In this objective, we'll look at post-acquisition expenditures. What this means is that when a company acquires assets, there may be expenditures that occur after the asset is already owned and already put in place. What are those expenditures? Companies spend money on acquiring long-term assets for use in their business and on maintaining those assets in productive shape. Some of those expenditures clearly create no additional value beyond the period of the expenditure, but some of them have benefits over many future periods. How do post-acquisition expenditures appear in financial statements? The objective here is students will be able to differentiate subsequent expenditures on long-term assets as capital expenditures or operating expenditures. Let's get some terminology down. Expenditure is the name for a cash outflow for the purchase of goods or services, whether it's cash or perhaps credit. A capital expenditure is a particular kind of expenditure. These are purchases that are recorded as assets rather than being simply expenses. Asset-related expenditures that will benefit more than one period are called capital expenditures. Capital expenditures add new fixed assets or increase the capacity, efficiency, or useful life of an existing fixed asset. That's the principle that we're going to use in this unit. There are no particular rules about specific items to expense or capitalize. Instead, the accountant needs to use his judgment, and different accountants may come up with a different decision on whether something should be capitalized or whether something should be expensed. In practice, repairs, parts, and similar items are always expensed. Most of these expenditures are minor, so the cost-benefit and materiality concepts justify this choice. Repairs and maintenance are required to keep an asset in good working order. Repairs include costs of fixing an asset after a breakdown or an accident. Maintenance includes routine costs of keeping the asset in good condition, such as oiling, painting, and adjusting. Both repairs and maintenance are period costs and are treated as expenses. Now, let's distinguish those period costs from items that are identified as additions. An addition is an expenditure for a new asset associated with an existing asset. Examples are building our second story or adding a wing. Additions are capitalized. They add to the value of an asset. Changes to existing assets to accommodate the addition may be capitalized if they're planned and enhancing, or they may be expensed if it involves a removal or the equivalent of a repair. Improvements are the next capital expenditure. This is an expenditure that's intended to add to the future benefits from an existing fixed asset. Examples would be renovating an apartment building so that the rent can be increased, or rebuilding a packaging machine so the capacity is increased or its useful life extended. Improvements require adjustments to existing accounting records of the asset. Either the book value of the asset is increased if the productivity of the asset improves, or it's possible to decrease the accumulated depreciation that's been recorded if the useful life is being extended. Replacement is a third kind of capital expenditure. If the carrying value is known, one can remove the cost of the item that's being replaced and its accumulated depreciation and recognize any gain or loss, and then capitalize the new asset. Often, however, the carrying value of that specific component that's being replaced is not known, so we simply decrease the accumulated depreciation to accommodate the extended useful life. Or, If the carrying value is unknown and it's not an extended life, but the quality of the asset is being improved, we could increase the asset value directly. Rearrangements and reinstallations are a final kind of capital expenditure. If the original installation cost is known, then we'll replace the former cost with the new cost. If the original cost is not known, that is, it might have been part of a lump sum and can't be distinguished, but there is some identifiable future benefit, then the cost would be capitalized. Otherwise, if there's not an identifiable future benefit, then the cost of rearrangement and reinstallation would be expensed as a current period cost. We've identified reasons why costs that are made after the acquisition of an asset would result in making the asset more valuable. Those expenditures are called capital expenditures, and they increase the assets of the organization. If a cost does not meet these criteria, then we've got a decrease in owner's equity called an expense. Thank you.